Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia. Today, our webinar title is Investing in Asia's Tomorrow, Key Trends for 2024. My name is Shen Chu. I'm the moderator for this session. Now, there are many Asian markets who have underperformed the American market this year. So this doesn't mean that it is a value buy. What are the investment merits for Asia in 2024, and what are the key growth that can propel Asia growth in 2024, and what is the economic outlook like? So these are the questions that we address in this webinar. Before we begin, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed shares that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. And today, we are very honored to have invited the portfolio manager from Principal Asset Management Private Limited, Mr. Shawn Ho, to share with us his view about the investing in Asia's tomorrow. So allow me to briefly introduce Mr. Shawn Ho. Now, Mr. Shawn Ho joined Principal Asset Management Private Limited in 2015 and currently manages the Principal Asia Pacific Renewables Fund, China, India, Indonesia Opportunities Fund, as well as other segregated mandates. Shawn is also the co-manager for the Principal Asset Pacific Dynamic Mixed Income Fund, Principal Asia Pacific Dynamic Growth Fund, and Principal Asia Titans Fund. He has over 10 years of experience in the financial industry. Prior to joining Principals, he was special officer to then CEO of CMB Group, where he gained regional and broad-based exposure to various parts of the bank. He started his career as a management trainee with CMB Group. Now, Shawn is the firm's country strategist for China, responsible for developing the firm's view on the Chinese economy and equity market. Shawn also leads the firm's internet task force responsible for coverage of the sector. So he holds a master's in the real estate finance from the University of Cambridge and has also passed the Chartered Financial Analyst Level 2 examination. So welcome, Shawn, to today's webinar. How are you today?
Hi, good evening, everyone. I'm very well. Hope you are well too.
Yes, thank you so much, Shawn. Okay, so without further ado, let me just hand over the control to you. You may go ahead by sharing your slide.
Okay. So firstly, very good evening to everyone. I hope that wherever you are well. And thank you for taking the time of evening, of your busy work schedules to spend with me this evening. I also wanted to say thank you to Bursa for this invitation to myself and my company for this opportunity to share with you our views on the Asia markets. I think it's fantastic that Bursa is doing all this for to improve awareness and to improve financial literacy in the Malaysia market. And I really hope that you will ask me a lot of questions at the very end so that we can learn from each other as well. Okay. So there's quite a lot of information that I prepared for you today because I wanted to keep this informative and useful for you, right? And if at any time you want to go back in the future to look at certain slides and so on, this will be available on YouTube as well, right? So let's start off by first giving everyone a recap, right? Some context on what has been happening so far in the equities market, right? If you just look at, this is the market performance, right? Capital returns. If you just look at year to date, as of end of October, right? You notice that, as Shane rightly pointed out at the very start, US market has done very well, right? It's up 9.2% in US dollar terms year to date. And Asia has really underperformed, right? It's down 6.7% in US dollar terms, right? If you just look within Asia, right, the markets that have done slightly better this year would be, for example, Taiwan, up 13%, right? And India, for example, is up 5%, right? So this is just to give you a sense of where we are so far and how challenging it has been actually for Asia managers such as myself so far. Right? What we wanted to share with you through this slide is really a very simple diagram to show you that this is the longest bear market that we have seen in recent history, right? For many of us who have been working in the last 10 years, even the more senior people who have been around for the last 20 plus years, right? This would be the longest equity market peak to trough that we have seen, right? So what this dotted line shows you is that since February 2021, where Asia peaked, it has subsequently been coming down for the next 32 months, right? And is down around 35% from the peak, right? This is the longest bear market, if you will, since 1997, right? And the only other times when the markets decline more than this is really during the Asian financial crisis, which is the blue line here, as well as the global financial crisis in the orange line here, right? Where they both decline more than 50%. So it's been a very long bear market. And what we wanted to show with this slide is to tell you that the amount of subsequent returns that the Asia equity market has produced after this bear market ends, right? So this is just a rough sanity check, if you will, to show you that actually the bigger the decline, right? So for example, EFC, where it fell 57%, in the next 12 months after that, they actually returned 77%, if you were smart enough to buy at the very bottom of the Asian financial crisis, right? And subsequently as well, in the global financial crisis, it actually rebounded 91% from the bottom in the next 12 months, right? As well, actually during COVID, it actually produced a very big rebound of 60+% from the COVID correction, right? So this is just to tell everyone that we are going through a bear market right now, but at some point, this bear market will end and it will produce decent returns when that happens. Okay, so this is, as I mentioned, to give you context of the global economy, right? And you are probably quite well versed with what we call PMI, right? Purchasing Manufacturers Index. And what this shows you in the middle, right? At the top are developed markets PMI as of October, right? Versus emerging markets. So I don't want you to focus too much on the specific numbers through most of these slides. Just follow what I'm trying to explain, right? And the picture I'm trying to tell you is that developed markets in general are signaling that the economy going forward will be slightly weaker than emerging markets, right? Because most of the developed markets right now, the PMI is in contractionary phase, meaning below 50. Right? For emerging markets, most of them, or many of them, right, are actually above 50, such as India, very strong, 55, Indonesia, Singapore, and Philippines, right? And these are the Asia markets that we're talking about. Right? And just to tell you on the Forex currency changes year to date, this column here, you can see that most currencies actually depreciated against the US dollar. US dollar has been very strong, right? And in particular, Japan has been one of the biggest decliners, right? It is down 12.8% year to date. Very, very big decline, right? Which is why a lot of people are traveling to Japan right now. And so this is on the US economy GDP growth itself, right? And what this chart is telling you is that the financial markets as a whole are expecting a soft landing for the US economy, right? When I mean soft landing, what I mean is that on a quarterly to quarterly basis, the US economy has been very strong. Yes, it has been growing 2+% quarter to quarter, right? But going forward in this quarter alone, it will slow down to 0.8 Q on Q, right? And then it will slow down further in the first quarter of next year to 0.3, and then subsequently it may recover, right? But at this point, I would say that this growth here is a bit more uncertain, and depending on the high frequency numbers that the US reports in the months ahead, this could potentially be revised lower. Right? And this is also the reason why we started seeing some decline in bond yields and rates after the US has been reporting slightly weaker numbers recently. So this is the market's expectation for interest rates, right, which everyone is very interested in going forward. So what the FOMC median dot plot is basically a compilation of all the FOMC members, what they think individually, what they think the Fed policy rate will be in the months ahead, right? So you can see that the dotted line, the light blue one, is what they expected in March. And since then, as of September, it has been raised, right? Meaning the higher for longer narrative has happened, right? So they are expecting, but they are also expecting that the rates will peak at the end of this year and gradually come down towards the end of next year. What is more interesting is that the financial markets, right, which tend to be in a way more sensitive to economic changes, right? They are taking a view that the rates will peak at 5.4, right? Slightly later around January, right? And then it will come down. The latest number here is that it will come down close to 100 basis points to 4.4% by the end of next year. So it's a big decline in interest rates over next year. So on interest rates in Asia, right, I just wanted you to look at the big picture, which is that if you look, when you come with me in the middle column, right, this is the forecast our firm has over the next 6 months for interest rates. You will see that most countries are staying unchanged. We expect most countries to stay unchanged over the next 6 months, right? Except for Indonesia to maybe potentially increase one more time, and China to potentially cut interest rates one more time. Right? But we expect countries such as Malaysia to keep interest rates unchanged. And why is that so? Because actually, since the Fed started raising interest rates, what we call the real interest rate has improved, has gone up a lot, right? So real interest rates are simply the policy rates that countries have minus the inflation that in this case we use the latest this quarter's inflation expectation, right? So this is the if you will real interest rate level, right? And you can see that the US went from very, very negative, right? This blue line in the middle, it went from -1+% all the way to over 2% at this point, right? So the US was being too overly stimulative, and now is having to raise interest rates to a more reasonable level. So countries in our region, such as Indonesia, China, Philippines, because inflation is still actually very low for especially China, Indo, and so on. So therefore, the real interest rate actually is actually still pretty high, right? Over 3% for Indonesia versus roughly 2% for the US, right? The countries where interest rates are a bit low, right, relative to US, right, not necessarily relative to its own history, right, are, for example, Taiwan, right, Korea, Malaysia, for example, and India, right? But this is just a very rough, crude way to look at interest rates, and it doesn't mean that everyone has to be above the US, right? It depends on many, many factors, such as bond supply, demand, and so on. Right? So I wanted to give you another bit more color on inflation, right? Because inflation clearly is very, very important for our stock markets, right? It really moves stock markets, if you will, right? And you can see that inflation, if you look 1 year before, was very high, right? So basically, you look at this column here, October 2022, inflation was generally in most countries much higher than they are currently, right? Which is why you see that as you move towards the left, it gets green because inflation is declining in most countries, right? Except for certain countries like Argentina, which is probably facing issues of its own, right? In terms of currency and so on. But if you look at Asia, more specifically, you see that even a country like India, which was having some inflationary issues, right, during the year, it has subsequently come down in most recent months, right? So inflation is well controlled, and this gives the central banks in Asia a bit more policy space to potentially move interest rates lower in line with the Fed, or even potentially before the Fed in certain cases, right? Okay, so I've given you a lot of numbers and so on so far, right? I don't want to bore everyone out of their minds, right? And let's talk about something more interesting, right? Which is maybe stock markets. So what really drives stock markets, right? Companies' earnings are certainly one very important factor, right? Which is why fund managers, professionals like myself, right, we have to look at earnings growth when we consider which markets to buy and so on. And you can see that in year 2023, this year, the earnings growth is generally quite lackluster, right, in most parts of the world. And when you look to next year, right, you will see that the latest expectation is that we are going to see some earnings recovery in most countries, right? And this is most pronounced in Asia, right? So Asia, for example, is going from 1% earnings growth to potentially closer to 20%, right, I would say, next year. US will probably see something closer to like more 10, 11%, right? And the other markets such as Europe and Japan are a bit lower growth on the fundamental earnings basis. So this gives us some fundamental backing or support when we look at stock markets, because earnings is growing. So unless multiples derate a lot, right? Otherwise, there will be upside over time for stock markets. So what is driving the earnings in Asia, right? So I want to say firstly that this is Asia Pac ex Japan, so it includes Australia, for example, right? And if you break it down, this Asia Pac ex Japan, which is where a lot of our funds are invested in, the sectors which are driving earnings growth are, for example, consumer discretionary, right? And communication services, which are expected to grow around close to 30% for both sectors next year. This is a very high number, and a lot of them are actually, some of them are the big ones, the big constituents in these sectors are actually internet companies in China, for example. Then the rest, we are seeing, a more balanced picture with weakness in certain industrials, for example, right? So it's very important that China internet, major players such as Tencent will continue delivering good earnings growth, right? Even in the last quarter, they have actually delivered good numbers, which is why the stock has kind of found a bottom in recent weeks. Just more, lastly on earnings, this is the earnings revision for next year, right? What this means is that the incremental change, the incremental revision that the market is changing for each equity market, right? So for global, on a global basis, we are seeing that earnings are roughly stable, right, so far over the last few months, right? There's no much change. You are indeed seeing some weakness in Asia, right? But it's not getting really a lot worse, right? The revision down to revision of 4% lower happened in the last few months, and then since then it's been roughly stable, right? We are actually seeing some earnings recovery in Indonesia, the purple line. So when you talk about Asia stock markets, China is a very important piece of this. It really drives a lot of demand of commodities and some of the end demand for companies, and it's a big country within our Asia Pac universe, right? So the problem that China has been facing, and we identified this actually quite a while back, more than 1 year ago, is the property market slowdown, right? This will show you on the headline kind of price changes so far, right? That it has actually come down quite significantly, right? And it's currently showing month on month decline on a headline number, right? But I will tell you that this official number may not be totally representative of what's on the ground, right? Which may be a more volatile, right? When we talk to companies and people on the ground, right? So there is a property market slowdown that we are standing in right now. Right? Then there's many reasons for this, which I can explain further if you ask me in the Q&A. Okay. So what is happening with Chinese families, Chinese households, right, in the midst of this slowdown, is that they're actually using their savings to repay the mortgages, right? And kind of like trying to repair their balance sheet instead of taking on new mortgages, right? Which is why when you see that on a whole, when you look at the outstanding amount of mortgages, outstanding meaning the amount of mortgages banks have lent to the households in total, right? This number used to be increasing 15, 20%, right, in the left side. And you see that come down all the way to negative, slightly negative. What it means is that not only are people not really taking on new loans, right? They are in fact net paying down the loans, right, that they have with the bank. And that shows you the kind of cautiousness that people are showing. Right? So when you look at the economy for China, I think that we are very cognizant that there are some major issues within the property sector, within the maybe lower income households that were hit during COVID and so on. And we have seen, but however, with all that said, we have seen that many of the weakest economic numbers that we track are more in the past than in the present, right? So there are many numbers here. You can look at some of the leading indicators for the economy, such as PMI, the inflation. You can look at the amount of investments happening in the economy, capacity utilization, and so on. I won't go into everyone, but what you should really try to take from this whole chart of numbers is that basically we are seeing that things are not getting a lot worse, right? You don't see much red color boxes on the right side, right? Things are not getting much worse, and they're kind of stabilizing at a very low level, right? Are they really improving very fast? No, right? And so what we need to see is that China arrests its economic and property sector slowdown, and they need to arrest the local government financing issues, right? And over time, we will start to see the economy gradually recover, right? But we're unlikely to see a very strong recovery in the very short term, right? But with all that said, the China market is very cheap. So this is just a compilation of the policies that has happened in July, August, right? And then more recently in September, October, right? So on the real estate front, they have been doing many things. So they, for example, cut the mortgage rates, right? The interest that you pay on mortgages for first home buyers, right? And they also reduced the down payments that people have to put up for first and second homes, right? To 20% and 30% respectively, right? This second home, if you were to buy a second house in China in the past, right, you would have to pay something between 30% to 80%, right? Some ridiculous number, depending on the city, as a down payment in order to buy it. This has all come down, right? And many cities have also lifted restrictions on who can buy houses in the city, right? So Guangzhou, for example, relaxed the restrictions such that you can buy you're able to buy more than one house in certain districts, right? And this was they were the first tier 1 city to do so. Right? On the government debt front, right, local governments are also encouraged to use these special local government bonds, the quota that they have, to repay what they have owed to private companies, right? And this is very important because when the government owes monies to companies, right, and they don't pay you on time, it sets a very bad taste in people's mouth, and it really deters businessmen. As I'm sure some of you online now today are businessmen as well. It really deters businessmen from making further investments in the country, right? So it's a good move that the central government is encouraging the local governments to pay back monies to companies as soon as possible, right? And of course, on the A-share capital market, they cut stamp duties, right? They reduced the amount of IPOs on new supply to the A-share stock market, and they also reduce the amount of selling that major shareholders can do for companies, right? So this is all to reduce the amount of supply of stock on the A-share market. Right? So there's been a lot of policies, and it's really getting a bit difficult to track all the policies happening in China sometimes. But these are just some for you, for example. Okay, more interestingly, the topic for today is what are some of the key trends in Asia, right? So there are actually many trends, right? But I picked up 2 or 3 trends right here. These are all countries, right? India, Indonesia, and Japan, to give you a bit more flavor of what's happening and what we like, right? So why India and Indonesia, right? I'm actually very positive on these 2 countries. Number one, you can see here that this is the world's productive population, right? And you can see that as a percentage of the total world's population, this has kind of peaked in 2010, right? So yes, the population in the world is growing, but the percentage the proportion of people who are between 15 to 64 years old who are able to work, this proportion is actually has peaked and is coming down slightly. Right? And you can see that this is the same in countries such as China, for example. Right? When we look at India and Indonesia, the opposite is happening. Right? You are seeing a big increase in the proportion of this productive population, right? And they're all between 65 to 70% of their population within this bracket. Right? Of course, this population doesn't mean everything, but it's a very good fundamental basis for the economic growth if the right policies and the right environment is in place. India and Indonesia are also some of the least indebted, the least leveraged countries in the world, right? What this means is that they have a lot of room to take on more debt to drive economic growth, right? And don't take this as something that is not as unsavory, the fact that they're able to do so is a positive, right? And there are not many countries that can drive economic growth just simply by organically, some of these tailwinds that they have, right? So if you look at the total credit in the economy, right, meaning the total amount of credit to governments, to households, as well as to corporates, right, as a percentage of GDP, Indonesia, with what we've collated here, is the lowest, right, amongst all these countries. India is also not far, and it's one of the lowest, right, as well. You look at countries there are more developed ones such as Hong Kong, Japan, Singapore, as well as the European countries like France. They're all very, very high, right? So this gives the India and Indonesia headroom, the bandwidth, the headroom to able to invest, right, and drive economic growth. So this is what we are seeing on the ground when we look at the numbers, right? What is happening in India is that we are starting to see an investment cycle happening, right? What this means is that we are starting to see private companies announcing more projects to build capacity, to build whether infrastructure and so on, or mainly productive capacity, manufacturing capacity and so on in India itself, right? And you can see that this is portrayed by the blue line here, right? It's going up. This has not been the case for the last 10 years, right? And as I'll try to share you later, India had gone through this mini boom, which created some problems in the past, right? And then they had to go through this period of digestion, right? And now they have kind of digested all this. Utilization is improving in the economy, and the companies are starting to be more positive and invest, right, in India. What are some of these investments? You would see it includes infrastructure such as roads, railways, airports, right? It includes basic stuff such as steel, cement, right, petrochemical, refining, renewables, and so on, right? So all this information is available for you on the right, right? I would say that in general, the investment is quite broad-based across most sectors. Right? Even the property sector right now is starting to see a property upturn, right? Which is why we are quite positive on the real estate developers in India. So India has gone through this multi-year deleveraging cycle, right? So I will focus on the blue line here at the bottom, right? So what this blue line shows you is the amount of non-performing loans that banks have on their balance sheet, right, versus the percentage of total loans that they have, right? And you see that the mini boom that I explained here, the infrastructure lending that went badly in since 2014, right, in India, this caused a quite a big increase in non-performing loans from 2% all the way to above 10% in India, right? And so really since 2018, right, we've been digesting this these non-performing loans, and now it's actually down all the way back to 4%, right? It's a much healthier level now, right? So what this tells you is that the banks have cleared away a lot of the bad debts in their balance sheets, right? And the banks are now ready to lend money to companies, right? And why we say that, if you look at the capital ratios for the banks, they're also very healthy. Right? This is the orange line, the tier 1 capital ratio. has gone from below 10% and is now around 15% in India. Right? So the banks have the capital to lend. Right? The companies as well have the capacity to borrow, which is the best part, right? So the gray line is the amount of debt versus equity, gross debt over equity for large listed companies that we collated. And you see that it has come down quite significantly from close from about close to 100% to below 60%. Indonesia is, if you look at the debt level, debt situation is not too different from India, right? But I wanted to talk a bit more about the current account for Indonesia, because that is what a lot of investors focus on. What this shows you is that the amount of imports versus the exports that Indonesia does for goods and services, right? This current account on a net basis was actually very weak in between 2012 to 2019. It was very, very significantly negative, right? Around 3%, 2-3% of GDP during that period, right? And so I was actually managing a country, Indonesia country fund during this the later periods of this, and it was a difficult environment, right? Because at the time the risk of currency depreciating was quite high, right? But this picture has changed significantly, right? So since COVID, it has actually gone above to a surplus, right? And this is not just because of COVID, of course, right? And it's really because of Indonesia's downstreaming strategy, where they are looking to, instead of mining for rock, right? Digging for rock and then exporting the rock somewhere else, right? And selling the rock. Now they're saying that, okay, we're going to be smarter about it, right? We're going to process the rock, right? As much as we can, further and further downstream over the years ahead. And we're going to sell eventually, for example, we're going to sell electric vehicle batteries, right, to the world in the future. And they're starting to get a lot of investments going to the country, right? So at the start right now, we're starting to see this first phase where they're processing the rock, nickel ore, for example, into MHP and so on. And they're not near to the electric vehicle battery stage yet, but they're progressing downstream, and that is already helping the current account, right? So going forward in the year ahead, next year, we should expect some between I would say 0.5 to 1% current account deficit. But I think you should also expect that for Indonesia, an emerging country that needs investments, right? That needs to borrow from the world to invest, right? A manageable current account deficit is very reasonable, right? That is what India has as well, a current account deficit. The question is whether there is confidence in the country, especially from real money investors such as companies, as also from financial market investors such as myself, such as bond investors, such that they will put money into the country to offset this, to fund this current account deficit. So one of the major hallmarks, if you will, for Jokowi, right, over his administration has been the amount of infrastructure that he has built. Right? So this is the amount of toll roads, highways, right, toll roads that has been built in Indonesia over the last 10 years. Right? You can see that this is by kilometer. Right? So between 2014 and 2022, they completed and built 2,500 kilometers of toll roads. Right? This is more than triple what they built in the 10 years before that. More than triple. And if you look at the years before that, you can see that in general, it's been a low level. Right? So this will help make things in Indonesia more efficient, right? Because now there are better roads, companies can move their manufacturing goods around easier and cheaper, right? Which is why you're seeing that the logistics cost, right, as a percentage of GDP has been coming down in Indonesia, right? It has come down from close to 30% pre-GFC and is now closer to low 20%, right? And we do expect this number to continue coming down. This will lower the operating costs of doing business in Indonesia structurally and improve Indonesia's attractiveness as a country for foreign direct investment, countries to invest, right? Hopefully to benefit from the China Plus One as well. Okay, so we've talked about two emerging markets so far. I hope I haven't bored you but too much, but bear with me just a little bit more. We're going to talk about a little bit about Japan here, right? Before we wrap it up, okay? So this is just to show you what's happening in Japan, right? And we wanted to start firstly with the central bank, the Bank of Japan's policies over the years, right? What I wanted, there's a lot of information here, and I would not ask you to go through all of them. What I wanted to tell you on a more overall basis is that essentially, since the global financial crisis, interest rates have come down quite significantly, right? So they cut interest rates, right? And the policy rate was effectively at zero, right, by late 2009, right? So this was since GFC. And then subsequently, they had all sorts of policies to expand the balance sheet significantly and so on, right? In fact, interest rates even went to minus 0.1, right, in 2016, right, when they introduced negative interest rates. Rewind to more recent times, right, you will see that since in the last few years, they have started this policy to control the yield curve, right? The yield curve has a shape, right? And this shape is according to the maturity, according to the time frame we're talking about, be it overnight, 1 month, 3 months, all the way to 30 years and so on, right? So there's a shape to the yield curve, and the central bank has said that they wanted to control the shape, right? And they committed to purchase Japanese government bonds, right, to keep the 10-year Japanese government bond yield at around 0%. Right? So this is what has happened, right, so far in terms of economic monetary policy. Very, very, I would say, unconventional monetary policy so far. So what has so this is just to elaborate a bit more on what I said just now, right? So since 2013, right, this is when we set the Governor Kuroda's appointments at the time, and they started to very aggressively increase the monetary base of the central bank, right? So they initially committed to double the monetary base within 2 years, which is a staggering pace of expansion, right? Double within 3 years, and then they subsequently expanded this program. So Japan has basically gone through very, very aggressive, very unconventional monetary policy because they had they had this issue of the lost decades and so on, right? Which we won't go into at this point, but they're also facing a population challenge. So they did all this in order to try to keep inflation expectations not from collapsing, right, in Japan, right? So subsequently, since Governor Ueda took office in April 23, he has since said that he'll be more flexible in this yield curve control, right? And therefore, but it will be gradual, right? It will be gradual if we were to tweak this yield curve control, right? And so we want to see inflation exceed expectations before we gradually normalize monetary policy from very overextended levels currently, right? And that is one of the important things happening in Japan, because the question is, can they get out of this deflation spiral that they have been facing in the decades before? So to elaborate a bit on this deflation, it's very scary. Imagine you're in an environment where your income, your wages, right? This orange line, something that all of us is very close to our hearts, right? What we are paid every month, right? Imagine your wages, this orange line, on a real basis after inflation has not increased, right? It's been roughly zero for many, many years, right? In this case, in this chart, we put since 2011 to 2020, COVID, it has essentially been zero growth in wages, right? How would you feel, right? How confident would you be to buy a bigger house, to spend more money and so on, right? And as you are aging, right? So in fact, if you look since COVID, real wages, because inflation has gone up, right? So real wages have in fact gone negative, minus 2.6, right? But inflation will, we hope, come down in the months ahead, and that should improve this real wages number, right? That's on just a number basis, right? But what is more important is whether the companies on the ground are willing and able to raise people's wages, right? And so one way to track it is through this spring wage negotiation that's done every year. And you'll see that the wage increase, right, really since 1990, since it peaked in 1989, right, has been coming down, right? And on a gross basis, right, on an absolute basis, this has actually been around 2%, right, since 1999 all the way till 2022, right, around 2% per year, gross basis, right. This actually started increasing in 2023, right, by around 3.7%. Yeah. And what we are seeing right now is that there's a couple of good signs from large Japanese companies, right, that have said that they will raise wages quite significantly in the year ahead, next year, right? And so therefore our sense is that this in the spring of 2024, we should see that wages actually improve beyond 3.7%, right? Firstly, to offset the lost purchasing power that households have had since COVID, right? So this will and also to over the many years we've never had a wage hike. Now is the time to do it, right? As the economy starts to improve incrementally from what Japan has been going through. Okay, I know we're running a bit late on time, so I will just quickly show you that in one of the drivers for wages is also the inflation outlook, right? And inflation is actually high, starting to pick up in Japan, right? So it was previously around 4%. This is the household number, right? Not the headline number. So the households were expecting around 4% in the past, right? And then suddenly, in the last 1-2 years, it has gone up to around 10%, right? And if you look at on the headline basis for the whole country, inflation has basically essentially been zero, right? You look at this, it's basically been zero inflation since basically 2000, right? Range bound up and down, but basically around zero. Right? And our sense is that inflation at this high level will start to come down, but probably stabilize at a higher level than zero than what is seen in the past, right, going forward. Okay, so Japan's PMI currently is still weak, the economy is still weak, but if we start to see some improvements in inflation, in wages, then we will start to see that this is what we call the inflation wage link, right? Inflation wage spiral will start to see improvement in the years ahead. So this is not a 1 month, 2 months, 3 months kind of trend. This is a multi-year trend that we want investors to be aware of, that you should, if we are right, then this may be multi-year improvements in, we hope, the Japan stock market as well, right? So the yen has been very weak so far, but we think that the yen may start to stabilize and potentially appreciate from very depressed levels, right, when the yield curve control is removed. Okay, so I've come to the end of my very, very long presentation. I hope you are still here with me, and I look forward to all your questions from here on. Thank you. Back to you, Shane.
Thank you so much, Shawn, for sharing with us insights into the Asian market. If you have any questions to ask our speaker today, please write them at the Q&A box, not the chat box, yeah? Write them at the Q&A box. Now, Shawn, we know that the oil price influenced the inflation number. So with 2 major wars happening right now, what is your view on the oil price? Will it be going up?
Okay, thanks, Stephanie, for the question. So we have a in-house view that oil price will be range bound between $80 to $100, right? This is a 1-year view, right? And it doesn't mean that oil price cannot undershoot or overshoot during this period. So the way we look at it is that we look at the supply situation, right, which is very tight, and we look at the demand as well, right, which we think that will stay quite sticky even in the event of a slowdown in the global economy, right? As you rightly pointed out, there potentially may be some supply issues if the war in the Middle East spreads very significantly, right? At this moment, that is not the case, right? We're not seeing the war really spread beyond, right, Gaza, right? It has to really spread and affect the shipping lanes, right, in the Straits of Hormuz, for there to be a spike in oil prices, right? So I would say that currently oil price at this level, around close to $80 is where we think that it's fairly priced. Right?
All right, thanks, Shawn, for sharing your perspective. The next question is from Maslan Yusuf. All right, so I'm not sure if you can do this forecast, but will Asia Pacific Index overtake Wall Street Index in the next 5 years?
Okay, Maslan, you asked me a very difficult question. So, given how Asia has performed so far, even if I told you yes, I'm not sure whether you would believe me, right? So, but the point is, jokes aside, we don't want to, we cannot give you a very explicit equity market view, because the reality is that no one can forecast equity markets accurately, right? And even more so between Asia and US, right? But what we can control and what we can tell you is that Asia markets are very cheap. They have derated significantly. The earnings are still growing and in fact are starting to pick up, right? If China doesn't slow down further, then we think that there's a very good chance that Asia will deliver absolute returns, right? At the moment, you know that US dollar is very strong, right? So when US dollar is very strong, emerging market, whether equities or bonds, tend to be affected, right? And it's a double whammy, right? Because in US dollar terms, the Asia stock markets look like it's down even more, right? But if you look at in our local currency terms, I think that you will see that we are still delivering positive returns year to date so far. If you look at ringgit in ringgit terms, for example.
Okay. All right. Now one of the concerns that investors have would be the possibility of a global recession, because from the inverted yield curve that the American bond market has been showing us, do you think it is likely to happen, or it's going to be a soft landing? What is the likelihood?
Okay, thanks, Elsie. So the likelihood of a soft landing is, in my opinion, more likely, right? But it's also not guaranteed. So we are watching very closely for what areas of stress there are, right? And normally, why do we call a black swan event, right? Because it happens because no one expects this to happen, right? So that is precisely why it's a black swan. So we are watching certain areas closely, where there are high leverage, be it commercial property, private credit, or private equity, and so on. But we're watching certain areas closely to see whether there's potential that things blow up, right? But if you just come back to us to what we invest in, right? Keep it more simple, right? What we invest in, we always try to avoid companies that are very highly indebted, that have the high risk of potentially blowing up in difficult conditions, right? And so therefore, whether there's a more significant recession or not, our hope is that the companies we invest in will always do better than the rest out there, right? And that's the best we can do for investors.
Thanks, Shawn, for addressing the question. There's one participant who asked, I'm surprised that the Russian inflation is not that high, and given that there are a lot of sanctions on Russia. So, what is the reason? If you have studied about the Russian's market.
Okay, I'm not a Russia specialist, right? I'm certainly as new to the market, right, as anyone else. But my understanding is that they have kind of had this initiative to decouple from the US, certainly, right, for many years already, right, for the last decade, right. So they have built up their own self-sufficiency such that they are able to run the country on its own, right. So why should there be high inflation when your currency is generally you are not importing a lot of goods, right? And so even if your currency depreciates, you're not seeing inflation increase because your products are getting more expensive to import, right? So they have been through this period of increasing self-sufficiency so that they don't need to rely on, they're not so vulnerable to the US and so on, trade sanctions and so on. Right? That I guess is one of the reasons, right? But I can't go further than that.
Yep. Shawn, just now you talk about the China's property market, and we have one question from Sue today who want you to clarify. Just now you asked us to ask you these questions during the Q&A. So what is this China property market debacle about?
Sure. Okay, so China, as you know, is an aging population, right? And one of the long-term implications of the aging population is that the property market tends to slow down, right? Because most people already own properties in China, right? And this is what we see from data as well, right? The ownership, the percentage of population that has a property is quite high, right? And within the affluent group, the percentage that has a second property is also not low, right? Within certain segments, right? So the people that need property that still don't have property yet are really the people who are new to cities, right? If you follow the migrants, right? People that are coming to the cities to work, right? So these people are the incremental demand, right? So China's urbanization rate, luckily, is still increasing and has still potential to increase around, let's say, 1% a year going forward. Right? It's still very low. I think, if I'm not wrong, it's around 60+%. It can potentially increase to the developed markets level of around 80%, right, over time, over the next many years. Right? So that's one helpful part for the property market. But the issue is that property prices are too high, right? I remember I was on the ground in China, in Shenzhen, in 2017 itself, and I was talking to people on the ground, and the prices that I heard had doubled in that 1 year. Right? These are all anecdotal hearsay, right? But the point is that Shenzhen market was the strongest property market at the time, right? People were making a lot of money between 2016, 2017, right? So that kind of set the stage for the very elevated property prices. And now that the demand has kind of come down for property, people are finding it hard to sell, right? And the government is not allowing prices to come down. Right? They're not allowing. You can't. It's not like Singapore, Malaysia, where we can. Today, if I want to cut loss and sell, I can sell at a lower price. You cannot register the property if it's below this guidance price, right? So the problem is that there's a lot of controls in place in China that prevents the real price of property to be transacted and cleared, right? That's number one, right? Which is why we're seeing this digestion period where there's very little transactions, right? And people are not really buying as many new properties as they did in the years before, right? So, and then the government had this initiative to, of course, tighten the leverage, tighten the debt levels of developers in order to prevent, I would say, excesses from happening, right? So these three red lines policies, for example, in the last few years, really tightened the liquidity situation for a lot of private developers, and a lot of them subsequently faced liquidity issues, right? They can't even pay the money that they owe to bondholders or banks and so on, right? So this created more negative press for the country, for property buyers, right? And then, of course, we had in the last 2 years an issue where developers could not complete certain projects that they had sold, right? So everything put together, that is the reason that property has been quite slow, right? Over 2022 and 23 so far, right? So it has declined more than 50%, right, in terms of total sales, right, over the last 2 years. So we are standing in the property crisis itself, and we think that at this point things are not getting worse. And indeed, if you look at the monthly numbers, they are not getting worse, right? And we hope that over the next year, with a lot of policies being released, with real money being put in through urban village renovation and so on, then we'll start seeing the monthly numbers start to improve over the year ahead. That's a very long-winded answer to your question. Thank you.
Yeah, thanks, Shawn, for sharing perspective in this housing debacle. Now we know that India is now the most populated country in the world, surpassing China. And as you mentioned that, China population is turning into aging population. And India and Indonesia, on the other hand, have a much younger and productive population as a percentage. So these are the investment merits into these two market. And when countries like India, they have this social class structure. And what is your view on this? And will it hinder any investment merit?
Okay, quite a touchy question, which I will politely shy from commenting. Right? I think most of us hope for a world where everyone is equal, where everyone, regardless of race, religion, caste, has the most opportunity that you have, right? So I will not comment on that question, but what I will say is that India is coming from a very low base. It is still a very poor country with a GDP per capita that is much lower than what most of our countries in Southeast Asia have, for example, right? So it's coming off a very low base, and it doesn't need to do a lot. It doesn't need to be perfect in order for India to grow at a very comfortable 6% GDP growth a year, right? So India has that going for it, right? It has a very hungry and hardworking population, right? It has a smart government that has aligned itself with the democracies of the world, that has been quite aggressive and smart in attracting foreign direct investment. It's probably one of the most aggressive amongst the emerging markets, right, that we see, right? And it has a lot of labor. It has a lot of hardworking people that are willing to work to improve their lives, right? So all this will help us to underpin a GDP growth of a very good level going forward, right? 6% per year. And there will be issues in every country. There's issues, even in Singapore there's issues, but that doesn't mean that India cannot do well in the years ahead.
I think last year they were one of the best, if not the best, market performance. How about, do you think that this year the valuation is fairly valued?
Yes. So the valuation of India, actually, contrary to what a lot of people think, is not that expensive, right? So you have to compare India to itself, right? It's currently trading around 20 times forward PE, right? And this is actually the 5-year average for the India stock market. Of course, if you compare to a lot of the other markets which have gone down, then maybe India looks expensive, but there's a reason why India is holding up so well, and that's because people have confidence of the future. There's a lot of liquidity being generated in the country, and that money is also partly going to the stock market. And all this come together to ensure that the stock market will probably stay expensive, right, and continue to deliver returns over the long term. And having invested in India over the last few years, it's always been expensive. It's nothing new. Expensive is a matter of perception.
All right, thank you, Shawn. Now India will elect the new prime minister between April and May next year. So which sector do you think will be impacted from a perspective?
Okay, so we do not expect any major political change at this point, right? Of course, elections are always hard to predict, and whatever surveys you look at, they can always be very different from the end result, right? So we will take it as it comes, right? So both India and Indonesia are both going through elections next year, and we do not, in both countries, right, we do not expect any major political changes, right? And therefore, we don't think that there's any real impact to the sectors, right? It will be business as usual.
All right, thank you so much, Shawn, for doing this Q&A segment for us. I think that most of the questions have been adequately addressed. So unfortunately, we have run out of time to do this session, and we overrun for a bit. So thank you so much, Shawn, for spending a precious time with us this evening to share with us the key trends for Asia in 2024. I hope that all of you here have gained enormous value from the session today. So, ladies and gentlemen, you just heard from the portfolio manager from Principal Asset Management, Mr. Shawn Ho. Thank you so much, Shawn.
Thanks, everyone. Have a good night. Bye-bye.